The US stock market briefly fell into a bear market, or just about, depending on which you look at. Globally, stocks have come off of their lows after being severely punished from October onward. Since the Fed meetings and forward guidance, the markets have rocketed higher as investors bought the dip. The PPT had a little fun and the algorithms jumped on the opportunity. But is this just a dead cat bounce? You came here for the truth, so let me unveil that for you. Today we're going to look at several economic issues that I believe are so important. So let's begin by taking a look at this. The Fang Stocks have come up 26% from their lows experienced on December 24th, 2018. I think it's important to look at the Fang Stocks because the market is obviously focusing on a handful of stocks to make the new gains. That was what happened in 2018 earlier on. We saw all the stocks falling throughout January into February, and then from that point up until October, it was only a handful. The Fang Stocks obviously leading the charge. We did see some problems with Facebook, for example. The stock got beaten up quite a bit because of scandal after scandal after scandal, but this is a different time now. In 2018, the markets are trying to rally right now because of the opportunity to get in or add to positions. The investors are feeling like there's no reason to have a recession right now, therefore this is a good opportunity. They don't understand quantitative easing. They don't understand what the Federal Reserve has done. All they know is that this is an opportunity based on some technical indicators that they've seen on some website or some guru told them about, and that's all they factor in. S&P VIX Index, you could see that that has come up off of its lows as well. It's still doing terribly, quite frankly. This was far into a bear market. When you look at the S&P Bank Index, you could look at global banks, you could look at the global systemically important banks, also known as the too big to fail banks. All of them were in a bear market or lower. They've come off the lows obviously, but it's still very bad for this entire sector. You're looking at the VIX Index, the most fake, the most manipulated index I've ever seen. This is basically trying to show us how volatile, how much risk there is in the market, and it couldn't be further from the truth. You're looking at this ever since the VIX peaked out in December. It's been coming down every single day since. It doesn't matter what happens in the markets, doesn't matter what happens geopolitically. As long as the VIX wants to, it will come down. It doesn't even matter what is actually happening. Leading up to the issues that were experienced throughout December, the VIX Index was moving up, but you could see the struggle. It was just trying to pull itself down further and further, and then it drops like a stone. Even though there are so many problems compounding on top of each other from October to December, the VIX Index really struggled to get to where it was. And now it seems like it's dropping like a stone. It's simply doing so regardless of what's happening, regardless of the underlying issues. And to top it off, we know that the Federal Reserve has a short position on the VIX Index, and this has obviously contributed to what we're seeing right now. The car recession and the retail recession have already arrived, in the sense that retail sales have peaked in 2015 and have gone down ever since. Cars have just been crushed. This article here out of Bloomberg is talking about what seems to be a recession for cars. People are not buying sedans any longer. They're choosing alternates, whether it's SUVs or so on. But we're looking at this coming at a time when these companies are really starting to suffer. This has been the case for so long. We've had sedans being the primary purchase for most people, and this is how their factories are made so that they can build these cars. They're outputting so many of these cars. These vehicles are being built up and they're sitting on lots. They can't sell them. So this is obviously being a huge change for these companies. They're starting to change things around, hopefully, and they'll turn around in in short order if things can change. But it's not the way that companies, especially these big companies, work. It tends to take a long time. There's a lot of bureaucracy. Is it going to happen? Is it not going to happen? But I believe that what we are experiencing today is really just a small issue in the wider scheme of things. A lot of people aren't aware of people's purchasing power today. It's maxed out by debt. They don't realize that. It's not just about sedans, although that's what the article is talking about. It has to do with people's purchasing power. Sedan slaying. Car sales plunge about 30% in the span of just 4 years. And that's the black line there that you can see where it peaked out in, I would say, about 2014 or so. It has come down ever since quite a bit. SUVs have been picking up year after year after year. That means more gas. That means more expenses, of course. That means generally more expensive vehicles. But let's not worry about that because the party never stops. China says its 2018 trade surplus with the US was the highest in more than a decade. This is a massive surplus that continues to grow, $323 billion in 2018, a number that only gets worse year after year after year. China is seriously winning in this case here. They have over $1 trillion in treasuries. They are definitely the lender and the US is definitely the borrower. This is becoming a huge problem for the US, pushing off their problems into the future, which of course only makes things worse. You cannot kick the can down the road. You cannot always borrow, because it doesn't work like that. Eventually it comes to bite you in the behind. Now this apparently is the highest on record dating back to 2006. So we could see that over the course of the last decade and more, this has only become worse. China is doing a very different thing than the United States. Whether that is going to last into the future, I don't know, but hey, at least since 2006, this has been the case. Exclusive, China to set lower GDP growth target of 6 to 6.5% in 2019. They had to do this at this point because China has obviously been fudging the numbers for way too long. They've been suggesting it's going to be 7%. We will not be able to go lower than 7%. You can count on us. And then we hear reports, so many of them, whether it was the report of under 2% of GDP is more realistic, whether we're going to see those 3 to 4% numbers. All I know is that the official numbers are going to be between 6 and 6.5% according to China. And they'll make it within 6 to 6.5. There's no problem there. They just fudge the numbers. Whether the real rate of growth is, I really don't know what it's going to be. But this is what China is presenting to us right now. And just a couple more articles to finish it off. German finance ministry often met Deutsche Bank on strategy in 2018. They met several times in 2018. I believe it's like 22 or 23 times discussing what is believed to be a merger. And of course, this is going to involve the government. The ECB is probably involved in this. Maybe the EU. Who knows what kind of level this has gotten to, but I'm sure that we're going to have some big news. And obviously the stockholders are loving this. The shareholders are basically elated at this point because they were so worried. They've been holding up until the very ground and they want to merge with Commerce Bank. So you're having two behemoths being put together in some sort of mad scientist plan to create the most dangerous company in the entire world. I don't know what the purpose of this is because it's already too big to fail. Deutsche Bank, last I checked, had about 50 trillion euro, and this only can get worse. Now, what exactly are they doing with all of this bad debt that they have? They're going to sell it off to investors? That is going to create a crisis in itself. No, it's not going to happen the next day, not the next month, but eventually it will. You can't get rid of garbage. What they do with all these garbage dumps out there. They put a tarp over it and they put a golf course on top, but it doesn't ever cover up the problem. The stink is still there. This right here is one last thing I wanted to show you. Ratio of household financial assets to nominal GDP. This has accelerated. This chart begins in 1955, and as of 1980, it basically went up in a straight line. And what's happening here? Well, obviously, as interest rates come down further and further and further, people have taken on more and more debt, and there's no corresponding relationship when you ask anybody in the financial industry. They don't seem to see it. Oh, could it be just a coincidence? This is in fact the problem. There is too much debt. And of course, it's always the case. You're gonna hear people say it. The debt is manageable. The debt doesn't cause a crisis. But I'll tell you something right now. The debt that you're unaware of, that you don't understand, is packaged up. It's securitized. It's collateralized. And that is sold off to investors, just like we saw in 2008. And while there might be a less amount total of derivative products that exist, all these crazy things that they created, it doesn't matter if their total quantity has been reduced. It's the fact that they exist. This is a problem. People aren't realizing. They don't get it through their heads. Okay, I'm going to end the video there. Before I rant on, I just wanted to finish off by suggesting what we are seeing today in the stock market could be just a dead cat bounce. We're only going to know in time. Actually, if you want to find out for sure, see the comment section. There's always a few individuals who seem to know exactly what's going to happen. So if you want their advice, please go down there because they seem to know everything. But seriously, when you look at what happens in the markets, I believe that the most important factor is what's happening with liquidity. The central banks either dish it out or pull it in. And what we are seeing today is the fact that central banks are pulling that in. They're reining in the liquidity. And I think we're going to have a problem. Whether that starts to escalate again anytime soon, I don't know. We got this government shutdown happening today. It has no effect on the markets whatsoever. Apparently, nobody really cares. It can go on for 6 months. They probably wouldn't even know what the hell hit them. But the Federal Reserve is apparently quote unquote dovish, and that's all really that matters. So we'll see what happens in March when the Federal Reserve has a meeting. They're going to sit down and they're going to either increase interest rates or they're going to let it slide this time around. If they let it slide, I think the market could definitely rocket higher from that point on. Their balance sheet right now is on autopilot. They're letting go, which I believe is, they're claiming 50 billion, but I think it's actually something like 36 billion. Either way, they're doing so on an autopilot. The market doesn't like that, and I don't know what the level is at which they're going to say this is too much. We'll see how it all unfolds. So I think that really it is all dependent on the Federal Reserve in the short term. If we don't hear too much from the Fed, I think that the market is going to remain positive simply because they don't know what the hell is going on. I do think that the next Fed meeting will have a big say in what happens the remainder of 2019. Obviously, it's not looking good overall because central banks are pulling back on the liquidity, something that the market can't stand on even a short-term scale. So we'll see what happens. That's all for this video. If you found it informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel. So I do appreciate that very much. And last but not least, if you want the financial education that you were not taught in school, these two books have everything you need. You want the foundation, you want the asset class, you want to know how to make money. Well, you can check that out at the link in the description. If you want the audiobook version, you can get that at themoneygps.com.